Hi folks, Scott here, and this is the wrap for Monday, April 29th. So let's talk about what tomorrow may bring us. The ES almost closed at a new 200-day high close. The cash indices actually did in the S&P. It's hard to tell, but for all intents and purposes, actually closed right at it, just a tad above it. And if you look at all the markets, you see they're in varying states of relative highs. See, the Russell's not quite there yet. NASDAQ closed clearly at a new one, and the cash index and the Dow not quite there either. So the roaring bull market continues. What I thought would be helpful to show you going into tomorrow are the results of fading gaps that did not close at a 200-day high close 2 days ago, but closed up today and within at least 0.5% of the 200-day high close. Meaning you closed up today, and you're at least, if you're down, you're only down a little, 0.5%, or you could have closed up. So pretty wide swath there. Okay, so simply closing up near 200-day highs is the way to think about it. And there you go. Odds slightly favor a gap down on the subsequent day. Both have very high win rates, slightly better win rates for fading a gap up. That tells you it tends to be profit taking. So longs will be locking in profits on a gap up. They see that as a gift. And historically, it's made more money. Average win size has been a little bit bigger. And this is using an end-of-the-day stop, not something I recommend, but a good place to start your analysis. You can see the average loss using an end-of-the-day stop has been quite a bit smaller, also about 20% smaller. So clearly, gap up is a little bit better, but a gap down is not bad, at least based upon the study. As always, I would defer to our gap guides and my worksheet and all my other analysis before I make my final decision. Ellie, do you have a question? What's that? You were going to bring me something to eat? Oh, darn. I thought you had cookies in your hand. Sorry, folks. I'll be done a little bit and can help you a little bit, okay? So, those are my thoughts going into tomorrow. Now, going into today, let me show you what the worksheet showed, because it made it pretty clear without a whole lot of work. This was not a great setup today. The majority of the indices, not all, but the majority of the indices gapped up and opened right at or above their prior day highs. And you can see prior day highs, looking at our worksheet, which was posted, actually it's normally posted each evening between 5 and 6 p.m. Eastern Time. Exception was this weekend. I didn't get it posted on Friday night because I was camping with my daughter. Didn't get it posted until Sunday, as I forewarned our members. But you still had it from 6 o'clock Sunday evening until this morning, and you saw that the odds of gap fill across all 8 indices, if opening above the prior highs, which was Friday's highs, was only 54% win rate using our MTG stops and a profit factor of 1.1. That's just not attractive. Not attractive at all for me. Hasn't made money. It's been a 50-50 kind of play. Gapping down between the high and close was a little bit more, well, basically in line with my minimum criteria. We had to dig into this one because we closed technically down. There are a bunch of red candlesticks on Friday, so that brought the DHO zone in play. And I know I have a lot of new folks that get lost, so just members, bear with me while I quickly show folks where to understand the gap zone map. Go to the gap zone map, and this is what we're talking about. Gapping above the prior highs after a down day, DH zone. So historically it's only 54%. Well, that's what the guide showed for today. And the DHO zone was an option today. If we gap down between Friday's highs and opened above Friday's open, that's not a great zone either, DHO zone. I jokingly say, pardon the terrible expression, but I used to be in the Army and had soldiers, and I had to tell them things like this. You always want to stay away from the hose. If you open up but between the open and the close, so in the DFC zone, that was a good zone today. That's why the average in the worksheet was better. These are 10-year numbers, very high-level numbers for 2 different scenarios, closing down or up on our gap zone map. But where was I? So back at the worksheet, you had to dig into that on those zones. But with the majority of indices opening at the highs or above it, it was a real easy one. No unique day factors that were positive. In terms of unique patterns, we did have technically an unfilled down gap, which surprised me because it didn't show up on some of my charts. But I don't consider any gap that's come within a point in the ES or 10 cents a spider is having not filled, because I believe most of the energy that would normally be associated with an unfilled gap is not there. Just, it's not really, it's just a different dynamic. I don't know how else to say it concisely, so I don't pay a whole lot of attention to it. Bottom line was, it wasn't a positive anyhow. It's normally a positive, but for a gap up today, it did not add. During a bullish market, after an unfilled down gap, a gap up the next day tends to be, somewhat ironically, not great. So here's what my pre-market comments showed this morning. Before I forget, if you're winging it and struggling, then you probably need the trader course. Honestly, it's a fantastic course. We've gotten rave reviews. Check out the testimonials. I did have a member ask, I won't call him out, but he says, if you're doing great in winging it, does he still need the trader course? The answer is yes, because it's easy. When everything's going well, it's easy to make money. It really is. If you're struggling, you start playing head games and you start risking more than you should, and you start making terrible decisions. Trader course will give you more discipline, all based upon achieving your goals, which is what this game is all about. So please check that out. You can save some money if you sign up by the 30th. Tim's done a fantastic job with it. All right, let's look at a couple other facts I had. Up gaps on Mondays, opening above the prior highs during a bullish market. Again, not great. That's just a generic confirmation, if you will, from the guides. If the gap was large, which is what I really wanted to show here, 41% win rate, 0.9 profit factor. And the ES did open technically above this level, so it was more than 40%. These numbers were in play. The only real positive that stood out to me was up gaps on the next to last trading day of a month during a bullish market tend to fill. Why? I'm not exactly sure, but they do. Today was an exception. That's why we don't pay attention to single data points, and especially ones with smaller sample sizes. So overall, you can read it, but neutral historical setup. Everything else is pretty mixed as well. So nothing terrible, but not compelling, but not terrible either. So I said I'd stand aside of the open, and that ended up being a good decision. The white line is where we opened. Blue line is the prior close. The sizable gap up, came down a few candlesticks. About 30 minutes it traded below the open, but once it got back near the highs, it did just like it did a couple of days ago. It stopped me out when it reversed. That's a pretty bullish scenario there at the open. And so avoid a losing gap trade. As a probability-based trader, you always want to pat yourself on the back when that happens. I'm not trying to pat me. I just followed history, right? There was no magic at all in my decision making today. I looked at a lot of data, shared it with you, and you came to the same conclusion as I if you passed on today's gap, which most of our members did, I'm sure. The 15-minute range guides were actually pretty compelling. They were the best setups today to the long side, and let me show them to you. High breakout. I'm looking for 55 and 1.1 here for the average of these three systems. Check for the YM, check for the NASDAQ, check for the Russell. All four futures strongly favor the 15-minute range high breakout. And on the ETFs, neutral in the spider. That was concerning to me, by the way. Diamonds, check, just right at it. Qs, right at it, just a tad weak. And then neutral in the Russell. So they weren't as compelling as I wanted, because I really thought I'd be taking it. Our advanced studies showed some risk factors as well. On a Monday to boot, which Monday is specifically a problem direction for the ES historically, and spider historically to the long side. So I decided to be a little bit more cautious, get long, but wait for a pullback. And if you look closely at this chart here, see the break of the magenta line? It broke and never came back to this line. So in fact, in full disclosure, and just being completely honest, I misspoke there. Some folks looked for a pullback there and did not get filled. I was being more conservative. I wanted to go to 82.75. I thought we had a chance, a little bit of pullback here. 82.75, 2 ticks above the open to get long, and that way it did not have to break the prior highs in order for me to get my target hit. So I was extra cautious and missed out on a winning trade. Just bottom line, it was a nice winner to the upside. The high breakout on the ES worked as well, and that had some positives, but it was not as clear and consistent, and it doesn't look like it worked in the Russell, even though the 15-minute one did, and 15-minute worked in the NASDAQ, and I'm not sure about the first hour. Dow, 15-minute and first hour both worked. So that was the right direction. The guides led you in that direction, just depending upon how you execute it today. So there you go. That was my day, and that is the wrap for Monday, April 29th.